the inflation picture in the Indian economy. We're looking at the December retail inflation picture, and that number, the CPI number, has gone up to 5.69%. This time, it's driven by rising food costs, particularly the elevated vegetable prices and household staples as well. But despite this kind of uptick that we're looking at in the CPI number, it remains within the Reserve Bank of India's target range of 2 to 6% for the fourth consecutive month now. And core inflation, on the other hand, has come in at 4.1% for December, which seems rather comfortable. But how comfortable is the Indian economy in right now when you consider the inflation, the battle on hand where the RBI has gone after inflation in a big way, and the kind of effect that the interest rate hikes have had on the economy so far? As we go into the presentation of the interim budget and going ahead, we're looking at the elections play out as well. So all of that are going to be at play when we talk about the inflation numbers. Let's connect with Indranil Pal, the chief economist at Yes Bank. He's joining us on the show. Great to have you with us. Mr. Pal, the base effect is pushing up the December inflation print, but overall, what's the sense that you're getting about the price momentum in the Indian economy at the moment, especially when it comes to the consumption basket? That, of course, includes food and housing.
We have seen a softening in the food prices on a month-on-month basis, and whatever early indicators that we have for even for January till about say yesterday, which is the 11th of January, the critical food prices in vegetables, pulses, cereals, everything seems to be on a declining trend. So the view, therefore, is that the peak of the inflation probably is beyond us. And after the 5.6%, 5.7% reading that we just saw, we should see inflation moving lower. But having said that, I think, are we in line with the 4% that the RBI has been looking at? Possibly no. In the remaining part of the year for January, February, and March, we would still possibly continue to see inflation higher than the 5% level, and the average for the full year should be around 5.4%. But surely inflation is moving lower, even on the food side, and more importantly also for the RBI, the core inflation has been moving lower, and it's just about 3.9% for the core metric that the RBI tracks.
Sense, Mr. Pan, how do you think the RBI and the MPC are placed now in keeping that balance between growth and inflation? Now we're seeing the less than expected rise in retail prices in December. But do you see now the central bank maintaining status quo deeper into the calendar year with those interest rates? This is a year of general elections. And do you believe that they will push back any decision for reversal of the rate cycle?
Well, if I take a leaf out of the previous MPC committee sort of minutes, I think a clear divide is emerging whereby the RBI continues to remind us, or the internal members continue to remind us of the risk that inflation carries even today, in the sense that we have seen a significant amount of climate changes. We have seen late rains in India. We have seen also certain sort of spurts of winter rains, which can have implication for crops. If I look at the Rabi sowing and the progress of the Rabi sowing, has been relatively muted compared to the previous year. We hope that it will pick up, but it's still quite muted, especially with respect to pulses. And some of the inflation containment that has happened today is not only because of the monetary policy, but also because of the fiscal policy in terms of, say, the almost an export ban on onions, a ban on the exports of certain categories of rice and wheat, etc. So it's a mixed picture at this point in time. And we also need to remember that even though rice sort of buffers are still quite strong, we do have a problem in terms of the wheat buffers. And if wheat production on the Rabi side does not remain strong enough, we can possibly see a rise in domestic inflation. So all these factors need to be kept in mind by the Reserve Bank of India while they actually pivot. And I do not think that the pivot is coming early. And our expectation, given the inflation or the modeling that we do, is somewhere around August, we can actually expect the RBI to cut rates. On the GDP inflation mix, I think the GDP being on the relatively stronger side, to a certain extent, being also pushed by government capital expenditure, does lead to a belief that the demand side is strong, while given the capital expenditure push, the supply side will sort of catch up with the demand side in some time. And therefore, from that perspective also, the pivot from the RBI may not be an immediate one.
Fair enough. But, now since you talked about there is a balance between what the RBI has doing with the monetary policy, interest rates have played out in the economy. Like, do you expect a higher food subsidy this time in the budget?
I think the food subsidy in the budget anyway needs to go up simply because the government has promised a free food grain through the PDS outlet for the next 5 years. So that is definitely guaranteed. Now, this budget, of course, we are not really expecting any major policy announcements to happen. And I think the finance minister also had been clearly pointing out that this is likely to be a vote on account budget, which will tide over the revenues and the expenditures of the government for the next 3 to 4 months before the new government is in place. But having said that, I also do believe that there is or likely to be a serious intent from the finance ministry and the government of India to provide for a consolidation. Much important because we are getting added to the bond index. And macros are something that will be very crucially dissected in terms of how we actually look at the scenario. So from that perspective, I think it may not be fair to say that we might actually have a populist budget, and we would continue to look at contractions in terms of the fiscal deficit GDP, with, of course, also a clear focus in terms of capital expenditures continuing to be the main driver for the economy.
Mention, Mr. Pan, that demand drivers are looking quite strong at the moment. But do you see any measures to boost consumption in the budget? And if so, will that
I've seen some press talking about whether there is a chance of the tax slabs being changed or even the standard deduction levels to be going up. Now, I don't think there's a problem with the urban consumption, especially with respect to the taxpayers that payers that we talk about. It's more the bottom of the pyramid that might still be sort of struggling with consumption in the post-COVID, and therefore implying that there is a deadweight loss that the economy is still carrying. And even at the 7.3% GDP growth, we are still not possibly back on track in terms of the trend line that we were seeing in the sort of COVID phase. So the area of concern remains the lower end or the bottom of the pyramid, and more specifically the rural India. Where I think the critical focus may not be through an immediate boost in consumption, but possibly trying to boost up R&D spends on agriculture and clear focus in terms of issues like a healthcare or an education, which to a certain extent is likely to push up the productivity in the future and help contain inflation pressures in the economy and also stabilize the consumption behavior in the Indian economy. So these are some of the areas that really sort of needs to be taken up by the government in the phase of economic momentum and development or policy making that we might be expecting.
Well, let's get in further perspective. Joining us is Madhvi Arora as well, the lead economist at Emkay Global Financial Services. Glad you could join us, Madhvi. What's your sense, looking at the kind of inflation print that's come in and the fact that we are going into the presentation of interim budget, we've got elections up ahead. As far as consumption is concerned, at this point in time, the kind of demand situation in the Indian economy, how much of a push towards consumption do you see? That much more resilient in an election year? Where do you think that's going to play out? Where is the balance going to be found?
So I think this kind of policy trade-off has always been the case, right? Every budget or any monetary policy regime tends to sort of face this kind of a dilemma or a trade-off with regard to growth and being relatively more prudent with regard to their interest rate regime or in fiscal regime. So both of these things generally tend to be at the forefront of any kind of fiscal consolidation that the government has done over the years. So I think given the fact the consumption story hasn't really played out as much, of course, there is going to be some bit of a populism that you may expect in the budget. Of course, you may not see anything big bang with regard to any announcement, given that it's a vote on account budget. But of course, there could be some tinkering here and there, which could probably, be driven towards consumption. And also, see, last 3-4 years, what you've seen is that capex growth has been steadily growing at around 30% or so. I think the coming year would see capex growth at least sort of stabilizing more toward 15-20% or even lesser. While revenue expenditure growth probably will see a much higher, print, partly on account of the fact that we have also sort of a base effect that, we will have with regard to the revenue expenditure. But that said, overall, I don't think the policy push would be materially consumption oriented. This government generally has been more supply side, more Austrian school of thought than Keynesian, and I think that spirit will continue in one form or the other. But there's a good chance that there would be a bit of a little bit bias in revenue expenditure versus last year, but the broad story of a supply side driven economy would not change.
Enough. We'll have to see exactly what the interim budget really brings to the table. As far as the inflation print is concerned, it is moderating, like Indranil Pan is pointing out as well, and which should make the RBI and the MPC rather sanguine in this kind of condition. And we'll see exactly how the budget changes things around. And for that, we have our experts joining us all the time. Thanks very much, Indranil Pan and Madhavi Arora, for joining us with your perspective on India tonight. We've completely run out of time on this edition of the show. We will be back, of course, on Business at 9 o'clock sharp here on ET Now. Until then, do take very good care of yourselves. I'm Vikram Oza. From me and the team, good evening.